Before you pay a single dirham in Dubai real estate, ask two questions. Is my money protected and can I exit when I need to? If you can't answer both with confidence, you don't have a deal, you have a hope. In this video, I'm going to give you my simple risk first playbook for 2025. I call it Wizard. It turns glossy brochures into clear go, adjust, or walk away decision. And I'll use it to explain the real difference between off-plan and ready property so you can choose what actually fits your goals. I am Edgar, Dubai Real Estate Advisor. I built Wizard because I kept seeing smart people lose money to fine print unrealistic ROI claims and timing mistakes. My approach is simple. No pressure, no spin, numbers only. Sometimes the best win is avoiding a bad deal. Today, you live with a clear checklist and the confidence to say yes or no in minutes. Here's the problem most investors face. The market looks simple from the outside. Choose an area, compare prices, buy, and wait. But Dubai is one of the most complex markets in the world. Different developers, different resale rules, different service charges, different timelines, and your exit rights can change everything. So let's strip it back to the essentials. First, understand why off-plan and ready behave differently. Off-plan promises a lower entry ticket and future appreciation. That's attractive, but your cash flow starts later. Your exit might be restricted by the SPA and your final numbers depend on the developer, the main contractor, and the timeline. You're buying a plan and a promise. Sometimes that promise is excellent. Sometimes it's expensive hope. Ready property is the opposite. You see the building, you see the service charges, you can verify actual rents, and you can usually sell tomorrow if you price it right. The trade-off is you pay today's market price and the upside story feels less exciting. But your yield and your exit are real from day one. So how do we compare them fairly? We score them with Wizard. 6 checkpoints, plain English. W means what's in escrow. Is your money going into a real escrow account with proper protection and audit? Are construction funds controlled the right way? If the answer is vague, the risk is high. If the answer is transparent and regulated, you move forward. I stands for installer and timeline, the builder and the schedule. Which main contractor is actually pouring the concrete? What's their delivery history? How many months did they delay on the last 3 projects? People talk about developers. Smart investors ask who is building and how often they hand over on time. Z is zone comps, not listings, not brochure dreams. Real transaction data in the micro location. If off-plan price per square foot is already near or above comparable ready sales, your future upside might be borrowed from your future self. If ready is trading cheaper on a real basis after fees, appreciation, and payment plan interest, then off-plan needs a better story than new tower, good view. A is all in cash flow, net, not gross rent. Net rent after realistic vacancy, service charges, furnishing, utilities, and management. If you're looking at short-term rentals, be honest about occupancy, management fees, and wear and tear. If you're looking at long-term rentals, be honest about incentives and void periods. Brochure ROI is marketing. Real ROI is after costs. R is resale rights. This one kills more deals than any other. What exactly does the SPA allow? Do you need to pay 40, 50, or 60% before you can resell? Is there an NOC fee? Are there penalties? If the market moves and you can't exit, you've given power to the developer. If your plan includes selling before handover, but the contract blocks you, that's not a plan. That's a trap. D is developer history, not just brand. What's the handover record? What's the snag ratio? How do service charges behave after handover? How quickly do they close maintenance tickets? Your tenant experience and your future resale price depend on these invisible details. Each checkpoint gets a score. Add them up. 80 to 100 is green, you go. 60 to 79 is amber. Adjust the price, negotiate terms, or change your plan. Below 60 is red. Walk away. Now, let's make this practical with a simple thought experiment. Imagine a ready one bedroom in a strong central area. Purchase all in around 1.9 million. Long-term rent achievable today, say 150,000. Service charges around 22,000. Net around 128,000. That's roughly 6.7% net yield from this quarter, with the ability to resell whenever you choose. If your pricing and marketing are right, your risks are building quality, tenant quality, and service charge behavior, all of which you can sample from reality before you buy. Now imagine an off-plan one-bedroom priced at 2 million. 50-50 payment plan. Handover in around 18 months. Let's assume the market behaves and you see 10% appreciation by handover. On paper, your unit is worth 2.2 million. Post handover, you rent at 155,000. Service charges around 24,000. Net about 131,000. On cost, that's 6.55%. Similar to the ready example, but you lost a year and a half of rent. Your resale may be blocked until a milestone, and your final outcome depends on construction and delivery quality. Is that bad? Not necessarily. If the micro location is primed for infrastructure upgrades, if the payment plan frees your cash for another investment, or if you secured a below market allocation early, off-plan can win. But if the price per square foot is already rich versus nearby ready deals and your exit is restricted, the risk-adjusted return may be worse, not better. This is why Wizard matters. In that ready example, escrow is irrelevant because funds go to a seller, but you do verify title and liabilities. The builder risk is historical, not future. Zone comps are clear. All-in cash flow is verifiable. Resale rights are open. Developer history is known. That often scores green, assuming the building isn't overpriced and the service charges aren't crazy. In the off-plan example, escrow might be fine, but timeline risk pulls the score down. Zone comps may be stretched. All-in cash flow looks similar but starts later. Resale is restricted. Developer is solid, but the contractor matters. That often lands in amber unless you negotiate a better entry or have a strong specific thesis for that site. What about short-term rentals? People expect them to crash long-term by 3 to 5%. Sometimes they do, but only when your occupancy, management fees, and utility costs are honest. Your building is tourist friendly and your micro location actually commands a premium. If your numbers assume perfect occupancy or ignore cleaning and replacements, you're overestimating. My rule, calculate long-term net as your baseline. If short-term can beat it after full cost and realistic occupancy, great. If not, don't force it. Here is your quick playbook to apply on any deal. Step 1. Price discipline. Pull real transactions for the micro location and compare price per square foot. If you are paying a premium, Write down exactly why that premium is justified by rent, views, finish quality, or supply constraints. Step 2. All-in net. Build a simple model with rent, vacancy, service charges, management, furnishing, utilities, maintenance, and a small reserve. Look at annual net, not monthly dreams. Now, step 3. Exit rules. Read SPA, not the percentage you must pay before resale, any penalties, and the NOC process. If your strategy relies on an early exit, that isn't allowed. Stop. Step 4. Builder and developer. Check who is building, not just who is selling. Search for their last deliveries, typical delays, and snag timelines. A small delay may be fine if your payment plan and personal cash flow can handle it. A big delay or a pattern of big delays crushes your internal rate of return. Step 5. Score it with Wizard. If it's green, proceed. If it's amber, adjust the price, the plan, or the timing. If it's red, walk away with a smile and find a better deal. The best investors are great at saying no. Now, a word about timing and mindset. Investors get in trouble when they buy because they're excited, not prepared. Excitement is for marketing. Preparation is for profit. If you use this framework, your decisions become calm and repeatable. You won't chase hype. You'll buy assets that pay you and protect you. So which is better in 2025? Off plan or ready? The honest answer is whichever scores higher for your specific goals and constraints. If you need income now, ready often wins. If you have time, a strong thesis on a micro location and a fair entry price with a good builder and clear exit rights, off plan can be excellent. The mistake is assuming one category is always better. It isn't. The score decides. If you want my one-page wizard checklist and an editable calculator, send me a message with the word wizard and tell me the building or area you're considering. I'll share the file and we'll run your target deal together. No pressure, just clarity. I'm Edgar. My mission is simple: protect your money, grow your money, and make sure you can exit on your terms. If this was useful, subscribe and share it with someone who's about to invest based on a brochure. Let's make it smart. Let's make smart decisions in Dubai. Numbers first, stories second. See you in the next video, guys. Take care.